What is going on today, YouTube? Today, we're going to talk about what it's like to invest in your 20s, your 30s, your 40s, and your 50s. And we're going to use this all from a nice little online calculator I found, and we're just going to use an index, a broad index, S&P 500. This isn't going to be a video about picking your own stocks and outperforming the market. It's more going to be a video if you're a long-term investor investing in low-cost index funds that replicate the S&P 500, which one of these, for example, would be Vanguard. Total Stock Market Index. Yes, it hasn't been around for as long as the S&P, but it replicates the S&P. So going back to the S&P, we're going to start this video off, and we're going to use the online calculator and look at the chart. But for this video's purposes, we're going to start in 1978. So if you start in 1978, you're retiring at 65. That would be 2018 of this year. 88, 98, 08, 18. So we're going to zoom in. 1978, 2018. Just looking at gains. I got to move this in a little bit. It's not going to be exact. But just looking at gains, you would have made about 26 times your money over that course. And that's not including dividends reinvested. That's not included any of that. Not including inflation, but we're going to break that down in this website I found. And I'm sure there's going to be some people out there saying, well, what if I just invested, when the market is going sideways, basically. I'm going to prove that you still make money in that time frame also. It's just a lot smaller than the gains, and it's a lot less of a time frame than being in for 40 years versus, let's say you got in at 1999, and we'll search 99 to 2012. So that's only 13 years that it was trending sideways, and you still would have made a little bit of money. So we're going to break all that down. So first of all, say you reinvested your dividends. We're going to go to this calculator. I'm going to turn it down a little bit so the brightness I'm not glowing. So you go to this calculator, January. We're going to go from 1978 to 2018. You're only investing $500 a month. And if you're saying right now, well, I can't do that, this is just an example. Say you figure out how to invest $500 per month, every month, at the end of the month, for 40 years. See what happens. Calculate. Total invested cost, $158,000. So let's say $160,000. You're going to come out with an annualized return of around 10% with $1.4 million. That's in 40 years' time. 40 years' time. Look at this. Look how slow it starts. It starts very, very slow. Then all of a sudden, it just starts going up like crazy. Because you have more money in there, it's compounding, you're reinvesting your dividends, and you are just staying in for the long term. So that's a case if you start when you're 25, planning on withdrawing when you're 65, and you left your money, $500 a month, in the market for 40 years. Just an index fund. You're not even outperforming the market. You're just going along with the market. It'd be pretty nice to invest $160,000 total throughout your lifetime and come out with $1.4 million. That's a huge difference. So now say we didn't start until we were in our 30s. We didn't start until we were 35. So we're going to go from 1978 to 1988. 1988 to 2018. Calculate. Look how much bigger of a difference that is. You're still investing around $140,000, so $20,000 less. But you are only making $580,000 when you take it out. That's crazy how much big of a difference those last 10 years made. Just for you taking 10 years off from your investments, you're making less than double what you would have made just from an extra 10 years. Losing it, starting in your 20s is just, it's amazing the difference that could have made. And honestly, if you can start before that, I'd figure out a way to. I didn't learn about investing until I was in my mid-20s. I wish I started when I was 18 years old. That would have been awesome. Even if I'm not putting anywhere near $500, say I can find a way to put away $100 a month or even $500 a year. That's still going to make a huge, huge difference when I'm ready to take out that money. Now we're going to get into even more of a shocker. Say you don't start until your 40s. So we're going to 1998. 20 years. Calculate. Total invested amount, $102,000, and you're coming out with $254,000. So you pretty much double your money. And this is still just investing $500 a month over that time frame. Now let's say you got a really, really late start. You start at 2008, so you have 10 years. You're going to invest $59,000 to pretty much double your money. You're going to double your money if you run for 20 years. But look at the difference in the chart even. 10 years money in the market compared to 40 years money in the market. We're going to go down to the chart when I hit calculate. Just watch this chart move. That's an amazing difference. That is why everyone says it's so important to start investing early and just keep your money in the market. When you reinvest your dividends and let it grow over time, it's really amazing what can happen. And then this is just investing in like broad index funds. You don't need to do anything fancy. You don't need to try to outperform the market, get the next Amazon, get the next Apple, get the next Microsoft. You just need to stay in and let your money work for you. Now we're going to go back to this chart. I just want to, okay, say for instance, you're like, okay, look how much more the markets went up over the past 10, 20, 30, 40 years. So we're just going to look. Say someone says you can't make any money if the market goes sideways. Yes, it's true. You're not going to make nearly as much money. But say it goes sideways, 13 years. We're going to look at from 1999 to 2013. So we're going to look at 14 years' time. Go back here. 1999 to 2013. 14-year time frame. Calculate. Total invested, almost $76,000. You are still returning about a 6.4%, even if the market's going sideways. You still make money because even though it's not making a difference, you're buying, basically if you're putting in $500 every month, you're buying more when it's down here and you're buying less when it's up here, but it's all going to average out. So the more you buy, it's going to make up for, you're going to purchase more when it's lower than when it's higher. So you purchase less up here, you purchase more down here. So you're going to purchase more. So your average is going to be more towards the lowers that it hits. And you just go completely sideways. Now, even, okay, we'll look at the last, say we do 13 years from 2018 to 2005. We'll go back and look at that calculator because that's when the market made a huge jump. So we go back over that calculator. Actually, we want to do 14 years. So we're going to do 2018 ending to 2004. Same time frame. Calculate. Putting in roughly the same amount of money, you're getting $173,000 off of an $80,000 investment, returning around 10.6%. Now, if we go back, look at that again from 1999, just remember the 10.6%. 99 to 2013, when the market's going sideways. Your returns are about cut in half, but you are still making money. So many people think, I'm not going to make any money if the market goes sideways, but that's not right. Because you invest your dividends and because you keep it in, it keeps on compounding over time. You're not going to make nearly as much, but you still make a nice return. That return's a lot more than just sitting in your bank account. Bank account, you might get 0.01% interest, which is nothing. That's a couple pennies every month. You are still making substantial gains. So that's it for the video, guys. If I taught you something, or if you enjoyed the video, give it a like. It really helps me out figuring out if I'm making good content for you guys. Leave a comment below if you got any questions. And if you really enjoyed my videos like this, subscribe to my channel. And I will see you in the next video.